Can your bond investments pay you every month like a salary? Yes, they can. And today, I'll show you how to structure your bonds to create a predictable income stream. In our previous videos, we talked about investing in government and corporate bonds and how their returns compare to other passive income vehicles like SACCOs, unit trust, which include MMFs, and real estate. Now, we are focusing on a strategy called bond laddering, which can help you earn money every month. A bond ladder is simply spreading your investments across different bonds that have different maturity dates and coupon payment months. Government bonds in Kenya, which are issued by the Central Bank of Kenya, usually pay interest every 6 months. And so if you want income every month, you can invest in 6 bonds with staggered coupon months. This means that each bond will pay you interest twice a year, but combined, you get a steady monthly cash flow. Currently, government bonds have an interest of between 12% and 14%, while corporate bonds will give you an interest return of between 10% and like 12%. Now, let's say you have 3 million shillings to invest. If you put all of it in one bond that's earning 12% per year, you will get around 360,000 shillings gross income every year. This is about 180,000 shillings every 6 months before tax is deducted. That is not bad, but it means that you only get paid twice a year. Instead, you could split your money into 6 portions of around 500,000 shillings and buy 6 bonds with different coupon months. The first bond will pay interest in January and July, the second in February and August, while bond 3 will pay every March and September, and so on. With the same 12% interest rate, you would still earn around 360,000 shillings a year, but this time it will be spread across 12 months, which means you'll be getting around 30,000 shillings per month before tax is deducted. A bond ladder can be useful to people who are retiring, which means that they will lose their active monthly income and therefore rely on the bond monthly income. Also, if you get laid off from your job, before you land your next job, you may depend on the income you get from the bonds. Income from the bond ladder can also be used to handle recurring household expenses such as rent, food, and utility costs. Here are the benefits of using the bond laddering strategy. First, you get monthly income. If bonds are your only source of income, a bond ladder gives you a chance to earn every month instead of the 6-month payment lump sum. Second, it offers liquidity and investment opportunities. Bonds are not liquid, but investing in a series of bonds offers different maturity dates. Some will mature in 2 years, while others will take up to 30 years. This ensures that some of the capital you invested in the bonds will become available after maturity, giving you a chance to reinvest them in the opportunities that will arise. Thirdly, there is a chance for higher income. Investing in one bond gives you only one interest rate over a lengthy period of time. For instance, if you invest all the 3 million in a bond that has a 12% interest and runs for 20 years, you will have to wait until the 20 years elapse, or you'll be forced to sell it via the secondary market. However, laddering will ensure that you invest in different bonds that have different interest rates. Some will be high, some will be low, and may raise the average interest. You are also likely to get money to invest in new bonds that open up, giving you a mix of both taxable and tax-free bonds. Lastly is managing inflation. When there is a high inflation, bonds typically deliver a higher return. And with one of the bonds maturing, you get a chance to get higher returns in your next investment. This will help you manage inflation. Potential drawbacks are that laddering requires significant capital and you will be tracking multiple bonds. What to consider when laddering your bonds? First is maturity dates. Always ensure that the different bonds you are taking have different maturity dates, in that one could be maturing in a few years and another could be maturing in a slightly longer period, giving you the potential of liquidating some of the capital without resorting to the secondary market where prices fluctuate. Second is interest payment months. Every time a bond is issued, always check the prospectus to see when coupons are paid. This is to ensure that you invest in bonds that have different coupon rates so that you get your interest rates paid in all 12 months. Thirdly, always check the interest rates and the interest type. Mix taxable and tax-free bonds to maximize your returns. In Kenya, bonds are issued on a monthly basis, while tax-free bonds are issued either twice or 3 times a year. Bond laddering is a simple way to turn bonds into a predictable monthly income stream. With careful planning, your bonds can start paying you like a salary, giving you financial stability even when your other active incomes stop. For this and more financial tips, we have a partnership with Lua. Lua is a free AI assistant on WhatsApp that can help you stay up to date with the news, ask questions via WhatsApp, or even apply for a loan from Numida. To get the business loan, visit money254.co.ke or use the link in our bio.